Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the best RSI indicator strategy that can transform your approach to the market. So if you have been struggling to identify precise entries and exit points, this powerful momentum oscillator might be exactly what you need. The RSI is simply known as the relative strength index. It isn't just another indicator on your chart, but it is a versatile tool that, when used correctly, can identify and improve your trading accuracy. So stay with me until the end of this video as I break down not only what the RSI indicator is, but also reveal a step-by-step strategy that you can implement in your trading immediately. Whether you're a beginner or an experienced trader, this strategy will help you spot potential reversals and confirm trends with great confidence. So what is the RSI indicator? Now this RSI indicator is also known as the relative strength index. It's a powerful momentum oscillator developed by J. Willis Welder in 1978 that has become one of the most popular technical indicators in forex trading today. This versatile tool measures the speed and magnitude of price movement, especially calculating the ratio of positive price change to negative price change over a specific period. The RSI operates on a scale of 0 to 100. It operates on a scale of 0 to 100, making it easy to interpret at first glance. What makes the RSI particularly valuable for you as a trader is its ability to identify potential overbought zones and oversold conditions in the market. When the RSI climbs above 70, once you see an RSI reading above 70, it typically indicates that an asset is overbought and potentially due for a downward correction. Conversely, when the RSI falls below 30, it suggests that the asset might be oversold and could be preparing for an upward movement. These key levels serve as a warning signal that can help you time your entries and exits more efficiently. So these are typically the zones we are talking about: overbought and oversold. Once it's below 30, we're looking at oversold regions, and once it's above 70, we're looking at overbought. Now, another most powerful application of the RSI can be identifying divergence. This is between price action and the indicator itself. When price make a new higher high, when price make a new higher high, but the indicator fails to make a new high, this is called a bearish divergence and might be signaling a reversal. Similarly, when price makes a new low but the indicator refuses to make a new low, this might signifies an upward movement. Typically, as you can see in this area of my chart, this price made a series of lower low. In this area we can see a lower low, but what can we see on the indicator? The indicator is making a series of higher low, signifying a bullish divergence. Once you see a divergence like this, just know that the price is about to reverse. Not always, but it is a confluence and a confirmation that we should go for higher prices. The standard RSI calculation uses a 14-period look back window. Though you can adjust this time frame, it is better to use a standard period look back window because it suits all trading styles. A short period makes the RSI more sensitive to price, potentially generating more signals but also more false signals. A longer period creates a smoother RSI line that may provide few but more reliable signals. While the RSI is an incredible tool on its own, combining it with other technical indicators like the moving average, support and resistance levels, or Bollinger Band can significantly enhance your trading decision. This multi-indicator approach helps you confirm signals and reduce the likelihood of false reading, giving you a more confident approach to your trading strategy, combining this with your trading strategy. So let's go into the best RSI indicator trading strategy we can apply in the market presently. The RSI trading strategy is designed to help you make smarter and more precise trading decisions by leveraging on the power of the RSI, which is the relative strength indicator. The relative strength index. This strategy focuses on identifying key market conditions, pinpointing entries and exit points, and managing risks effectively, all while ensuring that your trades align with the overall trends in the market. So let's break this down step by step so that you can implement this with confidence in your trading. We start by understanding the market environment. The RSI works differently in trending markets. The RSI tends to stay above 50 for a bullish trend. As you can see, in a bullish trend, you notice it's above 50. In this area, you can see it is above 50. This is basically what it means. Then it stays below 50 in a downtrend. As you can see, this area where the market was trending to the downside, if you can see, the market in this particular area was below 50, even if it peaks above once in a while, but generally stayed below 50. Meanwhile, a range bound market, the RSI confluence between an overbought, which is above 70, and an overbought, which is below 30. Your first task is to identify whether the market is trending or moving sideways. This will help you determine how you can make use of the RSI. Remember, if the market is moving sideways, you are typically going to see RSI moving from up to down, and as this, it will be going from up to down and up back. This is basically a ranging market, and you need to at least stay out of it except you are very good at it. Now, once you have identified the market condition, you set up your chart with a standard RSI of 14. 14 period has already been set on my RSI. For strong signal, you have to consider adjusting the overbought and oversold thresholds to 80 and 20, especially in volatile markets. This adjustment helps you to filter out false signals and focuses on extreme price movements that are more likely to lead to reversals. So if you feel that you need to adjust it, you can make use of 80 as your overbought and you make use of 20 as your oversold. This is basically what it means. Now let's talk about our entry for bullish trade. For bullish trade, you enter the moment you see the RSI dips below 30. As we can see in this area in the market, once you notice your market has dipped below 30, that should be your perfect example for a buy trade. And as you can see in this area, the market dipped below 30. This would have been a perfect opportunity to buy the trade in this area, even if it went for a short while. This is the 4 hour. If you had capitalized on this on the slower time frame, would have caught a higher trend, a higher move to the upside. Now, combining this signal with a little bit of price action. No, combining this with price action itself confirms that your signal might be the right one. You can use confirmation price action such as the bullish candlestick pattern. You can use the bullish candlestick pattern like an engulfing candle, or you can use patterns such as break of resistance or break of trend line, as the case may be. While for a bearish market, for a bearish trade, you look for the RSI to rise above 70. Now, if you are looking for a sell trade, you only need your RSI to rise above 30. This is basically what we will be looking for. And let's adjust our charts to get what we are talking about. So for the bearish signal, when the market, once the RSI peaks above 70, as you can see in this area, it typically signals an overbought condition, and then we are expecting price to drop below it, confirming this by a bearish candlestick pattern or a break below the support region. You can wait for price to break this support area for you to sell the trade. This is how we basically enter a sell and a buy trade. Another powerful tool within this strategy is divergence. Divergence occur when price moves in one direction while the RSI moves in the other direction. This is basically what this is talking about. Like I gave you an earlier example in this area when price moved from this area, creating a lower low, while at the same time the RSI was creating a higher low, signifying a bullish divergence, signaling a reversal from bearish to the bullish side. This is typically what divergence is all about. Divergence are particularly useful for spotting reversals early, but should always be confirmed with other indicators of price action before taking the trade. So before you take this trade, you can go to the higher time frame or whatever time frame to see the overall trend to further confirm your bias. Remember, exit points are equally critical in this strategy. Use previous support or resistance area for your take profit and stop loss areas. So if I'm to make use of this area, make use of this trading setup, I will draw my support and resistance zones on the chart to further simplify my chart. You can see this is resistance area, previous resistance that turns support. This is also a previous resistance that turns support. So if I'm to take the trade at this area, maybe the moment I saw price form my divergence and created a bullish engulfing that broke the previous structure or broke this previous resistance line, if I had taken my buy trade at this area, I will probably use this previous support area as an area to take my stop loss. Remember, risk management is non-negotiable in this strategy. So we have to always set our stop loss in a valuable area, an area that will invalidate the trading setup. While we can target our profits by using we can use a fixed profit target of 1:2 or 1:3 as the case may be. This is how we target for our profit, or we can target previous support or resistance area on the chart. Basically how we can use our profit target. To protect your capital, you must surely use a stop loss below recent low. Like I said, you use it below recent low for buy trades. In terms of a sell trade, if you are to take a sell trade, you put it above the low. In this area, when we notice price has gotten to, okay, perfect, when we notice price has gotten to our overbought area, remember you sell when price is in an overbought area, and we have gotten our confirmation by our bullish engulfing, or we use our evening star followed by an engulfing candle. You can enter the engulfing, we put our stop loss above. The stop loss must be placed above the previous swing high. In case of giving the market wants to do something like this, try to reverse, even if it did not take us out, but just to be safe, you give your stop loss enough room while you ride your take profit to a fixed take profit, or you go to the previous support region as a take profit area. Remember to always risk 1% of your trading account on each trade. Never risk more than 1% or 2% of your trading capital per trade while using this strategy. You always have to keep your risk consistent across all trades. Now, to enhance the strategy further, you can consider using the RSI with complementary indicators such as the Bollinger Band or moving averages. For instance, if the RSI shows an overbought condition and the price touches the upper part of a Bollinger Band, let's quickly add our Bollinger Band to make it easier to understand. As you can see, when price gets to an oversold region and it touch the top side of our Bollinger Band, is a better confluence to enter this trade because both indicators align. This is basically what it means. It shows that there might be signs of exhaustion and a potential reversal may be at its hand. Combining with tools like this can improve your accuracy and reduce false signals. By following the detailed step-by-step approach, you'll be able to use the best RSI indicator trading strategy to its full potential, and you'll be able to trade with it across different market conditions, or you can use it to trade either the forex, the stocks, or the crypto market. This strategy works in any market you are trying to trade in. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.